Today is Tuesday, the 4th of November, 2008, and this is Brian Shannon from AlphaTrends.net. We had another update here today. The SPY gained $3.39, or just about 3.5%. As you can see, we obviously took out that 99 to 99 and a quarter level, and the market looks like as though maybe it's even headed up towards that declining 50-day moving average. That's still quite a bit away, so I don't want to put anything out there that as far as making people believe that we're due for another 10% before we get a pullback, but it looks as though we're heading towards that level. It is, like I said, 10% away, and volume has remained low throughout this rally. So you have to continue to cast an eye of suspicion upon the overall action, but be very impressed with what we're seeing here on the intraday time frames. We can still see here that we've got these higher highs and higher lows. More importantly than anything, I think, is the direction of this 5-day moving average. When the 5-day moving average is advancing and prices are above it, you generally want to give the benefit of the doubt to the buyers in this time frame, which I could consider intermediate term, 2 to 5 days. So we've seen that since the market was able to recapture that 5-day moving average, and the 5-day moving average has been advancing, there's been no reason to be a short seller in here, and obviously we just continue to move higher. So let's take a look at the 60-minute time frame. There's a couple things I wanted to point it out here. Obviously we broke the trend line, and we were looking at resistance in here, which was broken, and what I was looking for was maybe more of a pullback in price, but I had pointed out yesterday that a correction in time like we've been seeing shows that there's actually an underlying bid in the market, and that a lot of times that leaves the market in a stronger position, and people will chase it higher, which is exactly what we're seeing in here. I did want to point out some potential levels that people may be looking at here from the this high here on September 19th down to the intraday low right here on October 10th. You can see that what I just did was take the retracement. So of this entire move from about 128 down towards 83 or so, 84, you can see that the 38.2% retracement, we're basically right at it. The 50% retracement ties in exactly with this high right here at about just a little over 105 and a half or so, and a 61.8% retracement up near about 111 or so. So this area has the potential to give pause for this rally. We do, it is very impressive, obviously, that this market continues to make these higher highs and higher lows here on this 30-minute time frame. Obviously, we can see just a real clear pattern of higher highs and higher lows. So you want to keep an eye on this trend line in here the next couple days, as well as that rising 5-day moving average. It seems as though the market has expended come a little too far too fast, but there's no reason to be selling short in here yet. The trend is still higher here on the intermediate term and shorter term time frames. Here you can see that a little shakeout near the end of the day, but we finished strong in here as well. So this market continues to rally in the face of an overall bear market. That will still remain for a while, but this, as I said, I think last Friday, this may end up being a rally that we can trade for the next several months. So the market is acting a lot better, and we have to change our analysis based on what the market action dictates, because only price pays. And if you've been fighting this because it's on low volume, or you think that the financial mess is still going to creep up and hit us again, and those are legitimate concerns, then you have to just put those thoughts to the side and trade based on price action. Yesterday I thought gold was it looked like I said it looks like the next shoe was ready to drop here in gold. Instead, gold rallied back up. The daily time frame, we've still got a declining 50-day moving average, so you want to continue to be careful with this, because again, the 200-day moving average is also declining. So we saw a rally within a downtrend, but I don't think that does anything at all to change the trend. Just as the big rally, 9% rally in oil today on some volume too. I don't think that did anything to change that longer term trend, but you can see that it has taken some important resistance out here on the USO at about 56.75 or so. So that ought to act as support if this market's going to continue to rally. We saw the pattern of lower highs and lower lows broken. We saw the higher lows in here. Here's our higher high, and now we've got a rising 5-day moving average. So intermediate term time frame, oil, the buyers are in control, looking like maybe 56 and a quarter to 56 and a half. Let's call that an important level of support for now, that if the market pulls back, that it may rally from there. But again, it's within the context of a primary downtrend, deeply oversold, so perhaps due for a little bit further bounce. So Russell 2000 was up 1.1%. So this market, the Russell, has been leading us higher, but it's slowed down a little bit today. So that's something to be aware of, that it was only up 1%, while the S&P 500 was up 3.5%, the NASDAQ was up almost 3%, and the group that's been leading us is starting to slow down. So that's something just to keep in the back of your mind. It's not a reason to sell short, because even on this 30-minute time frame, obviously we had broken the downtrend in there, and we've got a rising 5-day moving average. I think that an important level of support will probably be right around this 53 level. But again, in order for an alignment of trend back to the downside, what we want to see is this 5-day moving average flatten out and then begin to turn lower and prices be trapped underneath there for the shorter, for the safer rather short sales like we had seen in here and over in these areas. So the direction of the 5-day moving average needs to flatten out and then take support out as well before it's safe, I think, to start really looking at TWM. TWM, which is the double inverse Russell 2000, that continues to get to decline. It's got that declining 5-day moving average. The daily TWM is continuing to decline, and you can look at this 50-day moving average and say potential for support there, and this is where we've seen prior support as well at this level. But there's no reason to buy until the market gives us that is, price action gives us a specific reason to buy, and it's not there yet. So, if you're itching to get short, hopefully you've been waiting, on the sidelines in cash instead of fighting this upward momentum. But semiconductors also have been obviously a very important group in this market. They continue to rally on diminishing volume. We saw a little bit heavier volume in here today, but if we take a look at the 30-minute time frame in here and put some Fibonacci levels up, let's see, on that 60-minute time frame from the September 19th high down to its intraday lows. And again, these lows here, just to point this out, let's take a look at the monthly time frame again. Those lows actually undercut the 2002 lows for the semiconductors. So back to the 60-minute time frame here, we're right up to that 38.2% retracement. This market has just rallied from 17 to 21, so real big percentage move in these markets. We are still in a primary downtrend with that declining 50-day moving average, so you have to be lightening up into this rally. Don't be allocating more money with prices. I think that's a mistake. You want to add on pullbacks if this market can continue to rally. And in here on the 30-minute time frame, we've got these higher highs and higher lows. The distance this market seems to be rallying is slowing down a little bit, but again, not a reason to sell short. Important support in here, probably right around 20 and a quarter. That's where it would put this market back below the 5-day moving average, and just getting below the 5-day moving average is not a reason to think the market's falling apart and to sell short. You want to see that flatten out to start to turn higher and prices stay stuck below the 5-day moving average before you decide to get short. The NASDAQ 100 was up 93 cents on the Qs, that is, or 2.8%. You can see in here, obviously, we took out that level of resistance we've had our eye on, and that right in here is the area that I was hoping that we would get a pullback and see a head and shoulders pattern develop. And I was counting this as a shoulder. You could maybe count this as a shoulder Here's the head, and call this a shoulder here. If we were to get a measured move and continue higher from here, we would take the height of the head to the neckline, and we'll measure that very conservatively, add it to the breakout point. That would imply up near about $38 a share conservatively. But what we want to see now, obviously, is that we've taken this resistance out. We want to see this level act as support going forward. Breaking that support would be our first reason for concern. Breaking below here would give us even more reason for concern, because that would put us below the 5-day moving average. That 5-day moving average would flatten out, etc. But back to the 60-minute time frame in here, and I had pointed this out intraday on the blog, which was, this was the market I had shown the 38.2% retracement from this September 19th high here to the October, 24th low. We've seen almost exactly 38.2% retracement, and there's no magic to these Fibonacci numbers other than they tend to be an area where buyers will start to look at that and say, well, it's getting up to 38.2%, so maybe I'll stop buying. So that removes demand from the market. Other people who've been involved from lower prices will look at that 38.2 and say, I'm going to start to lighten up on my position because it's approaching this level that people watch that often acts as resistance, so they add more supply to the market. Short sellers also look at that and say, hey, it's at 38.2%, let's reload our short positions, and it becomes a self-fulfilling prophecy. A lot of this technical analysis does. The trick is to be aware of where these potential inflection points are, levels of interest where other people are looking at the market and making these decisions to buy, sell, or step aside, and formulating a plan that encompasses good money management and saying, where does the market come from, where does it have the potential to go to before it reaches that source of supply. And the 38.2% retracement might be one of those levels, because we are still in a primary downtrend.